Datavault AI Inc. is trading right now at $0.4672 per share, down close to 8% so far in the intraday session on a volume of over 36 million shares. If you look at the surface, it looks like a typical micro-cap tech stock getting kicked around by short-term traders. But here is what almost nobody in the retail space has processed yet. Just 3 days ago, this company signed a massive non-binding term sheet for a $2 billion structured financing transaction that values these exact shares between $1.55 and $2 each. Think about that massive dislocation between the public tape and an institutional valuation. That is a massive pricing disconnect right out in the open, and it sets up a bizarre game of tug-of-war between the daily retail panic you see on the charts and a massive backstop that could completely alter the financial foundation of this company. The general expectation from casual onlookers using standard investing sites is that a stock trading under 50 cents is just another highly volatile vehicle headed for endless dilution, especially when you look at its history under its old name, WISA Technologies. People see a low share price and assume it is a dying business model. But the reality underneath is a total corporate pivot toward real-world asset tokenization and enterprise data monetization, backed by an exclusive global mandate where their counterparties are legally bound to route all their digital asset projects through this single platform. The daily swings we are watching right now reflect a massive clash of market psychology. On one side, you have high-volume churn from day traders on platforms like the Robinhood app or using interactive brokers trading platforms, reacting to short-term momentum and past dilution fears. On the other hand, institutional activity is quietly building a structural floor that looks entirely different from the retail narrative. When a company with a market cap sitting around $400 million suddenly commands a non-binding agreement tied to a $2 billion portfolio of fixed-income securities, it forces you to look closely at the math. This structured financing is designed to give the company a massive collateral base to power its digital asset exchanges. If you were doing online investing through traditional platforms like a Fidelity brokerage account or tracking data on the SoFi trading platform, this kind of complexity often gets missed by automated algorithmic screeners. They just see an unprofitable semiconductor-turned data company with an earnings report from mid-May showing negative net income, and they sell it down. But the expectation of continued distress is hitting a wall of massive new catalysts, including a brand new mutual services agreement with Perpetuals.com to list major real-world asset tokenization programs on a regulated exchange platform in Europe. We are talking about confirmed targeted token issuances of over $328 million, covering massive physical commodities like the MTB Copper Project, gold, and strategic minerals. Comment below how many shares of Datavault AI Inc. you currently hold, or if you are tracking it on your watch list. When you look at how people approach self-investing these days, whether they are buying fractional shares on a mobile app or managing a long-term individual brokerage portfolio, the tendency is to stick to high-profile names like Tesla stock, Apple stock, or Nvidia stock. Those companies have highly predictable corporate structures, but true alpha often hides in these messy structural transformations where the old corporate identity is stripped away and replaced by a completely different engine. This company used to be known as WISA Technologies, focused on wireless audio standards and data over sound systems. In early 2025, they completed a complete structural shift by executing an asset purchase from Datavault Holdings, rebranded entirely, and moved their high computing capability platforms straight into enterprise data valuation and cybersecure monetization. They are literally using proprietary artificial intelligence agents to score and value corporate data assets, matching that with blockchain infrastructure to issue digital credentials and tokenized physical assets. Yet because the legacy share structure carries the weight of past shareholder dilution, the current market reality remains highly depressed. This creates a fascinating tension for anyone using online investment tools. If you look at the consensus among specialized analysts, the estimated internal fair value sits significantly higher than the public trading price, but the market is demanding concrete proof that these multi-billion-dollar term sheets turn into hard binding revenue. Financially, management has thrown down a massive gauntlet by reiterating their full-year guidance for 2026, targeting a revenue base of at least $200 million. That represents a projected 400% growth rate year over year. In a market where traditional tech firms are struggling to maintain double-digit growth, a microcap forecasting that kind of massive acceleration should be commanding a massive premium, but instead it is trading at a deep discount. Why? Because the market has a massive visibility problem. Institutional investors who manage funds through Schwab Intelligent Portfolios or massive Fidelity mutual funds generally avoid companies with sub-$1 share prices due to strict regulatory compliance mandates. They can't hold a stock like this in a standard Fidelity wealth management account or included in broad-based Fidelity ETFs until it proves structural stability and stays comfortably above compliance thresholds.
This keeps the stock pinned down in the playground of retail active investing, where emotional trading rules the day. The core business model now relies on creating an ecosystem where data becomes liquid capital. But using their platforms like ADIO for data over sound transmission and VerifyU for tokenized identity validation, they're trying to bridge traditional corporate finance with decentralized ledgers. If their exchange listing on the regulated European multilateral trading facility successfully democratizes access to institutional commodity trading for retail investors, the transaction fees alone could completely validate that $200 million revenue target. The fundamental risk here is the classic execution gap that separates a non-binding term sheet from a finalized corporate balance sheet. If you are building a portfolio on SoFi Invest or allocating capital via a Robinhood stock trading account, you have to weigh this structural volatility against the immense upside of their exclusive tokenization mandates. The stock has shown massive historical volatility over the past quarter, fueled by significant insider activity and the lingering effects of historical share issuance. But the reality is that the underlying revenue lines have started showing sequential spikes, moving from a couple of $1 million a quarter to over $33 million in late 2025, before normalizing into the current transitional phase. The expectation of failure is based entirely on the rearview mirror of what this company used to be. The reality of success hinges entirely on whether this $2 billion structured financing deal closes, providing the absolute ironclad balance sheet needed to scale their supercomputing data operations globally. To wrap this all up, Datavault AI Inc. presents one of the most extreme case studies in the current market of how massive the gap can be between public market perception and private institutional valuation. The retail crowd sees a highly volatile stock slipping under 50 cents on a Thursday afternoon, while institutional partners are drafting agreements that treat the exact same equity as an asset worth multiple times that amount, based on an exclusive global grip on real-world asset tokenization. Whether you are executing trades through interactive brokers' fee schedules or holding specialized assets inside Fidelity IRAs, the lesson here is that corporate structural pivots are incredibly messy but highly consequential. The tension between the old wireless audio legacy and the new high computing data monetization engine will ultimately resolve based on hard execution metrics over the next 2 quarters. If management hits even a fraction of their aggressive revenue targets and hardens their multi-billion-dollar financing lines, the current market pricing will look like a brief historical anomaly in a much larger structural transformation. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.